Hey guys, Jack here. Today we're going to be covering the different methods of investing in gold in the UK. We're first going to be touching on why you should invest in gold. Then we're going to be diving into the different methods and ultimately deciding which is better, gold shares, so gold ETFs, or actually investing in the physical asset. But before we get into that, we need to first figure out why gold is a good or bad investment in the UK. Historically, gold is considered a hedge against inflation. Now, we've probably heard the statement thousands of times, but does the data behind this really back it up? Now, during the whole research for this video, I found a couple of research papers which had some very surprising things. Now, all the data and all the research I read, they all kind of indicated to one thing. Gold is a hedge against inflation, but over a long period of time. Now, the key phrase here is longer period of time. Now, one of the reports actually stated a very interesting thing. They pointed out that an army officer 2000 years ago, a Roman centurion to be precise, received a salary of 38 ounces of gold. Now, it's not interesting that it's 38 ounces of gold. It's interesting that that amount of gold is actually around £50,000 in today's money. And if you look at what a senior army officer would get in the British Army, it is around £50,000. So back in the day, the army officer was getting the gold equivalent of 50,000, and today you basically get the same as well. So from that data, you can see that the gold does stand the test of time when it comes to inflation. They also did the same thing by comparing the price of bread back in the day, which was paid in gold, to the price of bread now, and it was about the same. So what does this actually mean in simple terms? Over 2,000 years, the purchasing power of gold, what you can actually get with gold, is the same. It hasn't decreased. Whereas obviously the power of US dollars and the UK pound has gone down. Now, the whole beating inflation thing was over 2,000 years. Now, we're not going to live for that long. So what does this mean for us? Does it hold value, or does it beat inflation in the short term, the years that actually matter to us? Now, the way to figure this out is that you need to compare the annual inflation rates and the price of gold. What we would expect to see if gold is really a hedge against inflation is that when inflation numbers are high, then the gold price should shoot up. And obviously the opposite when inflation levels are low. Gold prices should be shooting down or stabilizing somehow. Now, there's clearly more that affects the price of gold, but we really want to figure out that despite the ups and downs, does it provide a good return? Now, it all depends on what time frame we look at. If we look at a 5-year time frame, we see that gold has underperformed against the S&P 500. The S&P 500 has generated a return of around 100% since 2016. Now, in the same period, gold has only gone up 44%. However, that's only 5 years. If we change the time frame, then it's an entirely different story. But whatever the return is, gold does provide a good diversification for your investments, especially when times of uncertainty. People just rush to gold. It may balance out your portfolio where you see the stocks going down, but your gold has actually risen the portfolio back up. But what are the different ways of investing in gold? Well, the non-obvious way is going down the gold miner route. This is basically where you're investing in companies that specifically focus on mining gold. An example is Barrick Gold. This is a Canadian company which has 16 sites to mine gold all across the world. Now, investing in gold miners could provide you an annual dividend. For example, Barrick Gold provides a 1.61% dividend yield. Obviously, this isn't available if you invest in gold directly because it just sits there, it doesn't do anything. So investing in gold miners could be an alternative to directly investing in gold. If you invest in a gold company, you are actually exposing yourself to the risk behind the company as well. For example, the management team of the company can perform terribly, which can cause the fundamentals of the company to change. Also, new laws can be passed where it's much more costly to mine gold, so it affects the company's profit margins. So investing in a gold mining company isn't a pure gold play. Now, that just leaves us with a couple of options to invest in gold directly. Now, before I tell you those options and go through them and the pros and the cons, make sure you smash that like button and subscribe if you want more videos like this. It does really help out the channel. Anyway, let's get back into it. Now, one of the options is buying the physical asset, a bar or a coin, and the second is buying a gold ETF. Imagine this being a share of a giant vault full of gold. An example of such ETF is the SPDR Gold Trust. Now, behind the scenes it works in a very interesting way, but essentially each share you buy is backed by the physical gold asset or close enough. This means that it's very easy for you to buy and sell gold just like any other share on the stock market. It really makes it easy for you to invest in gold and get yourself exposed to the asset without actually buying the physical asset in your hand. Now, back in 2019, this SPDR Gold Trust actually held $31 billion worth of gold on behalf of its investors, both at the institutional and at the retail level. It actually made it one of the largest gold holders in the world. Since the ETF's inception in 2014, it has actually gone up 270%. Now, it's important to know that the prices that you see on the share are directly reflective of the gold market. It's as close you're going to get from actually owning gold without actually having the physical asset in your hand. Although this is great, there are some limitations to holding gold in this way against the physical asset in your hand. Now let's actually dive in so you can figure out which is the best approach for you. So with the physical asset, the benefit is obviously that you can hold it in your hand. It gives you the most control as possible. Ultimately, you won't be relying on any broker. For example, if the Trading212 app went bust and you would have to wait until you get your shares back. So there's definitely a benefit of holding the physical asset. However, in the same way, holding the physical asset requires storage. You're not going to just store it in your house. So you're going to have to pay some sort of storage fee. And then you might want to insure your gold in case your storage locker goes through some Hatton Garden style heist. Although holding the physical gold asset doesn't make you reliant on Trading212 or any broker, the reliance and the dependency ultimately falls back in the hands of the storage company. And in my personal opinion, non-financial advice, but holding the physical gold asset may be a bit more of a hassle. But let's actually dive in and look at some disadvantages of the ETF method, because there are some strange ones which may sway your decision. One of the disadvantages is that you have to pay a sponsor fee. This is a yearly fee paid to the ETF management company directly. It's mainly for the upkeep and the sort of maintenance that's required to hold all that gold, and normally the prices vary depending on the ETF you choose. Now, Ishares, which is owned by BlackRock, has one of the lowest ETFs on the market. Sponsor fee for its gold trust is around 0.25% a year. This means that you just have to pay £2.50 for every £1,000 worth of gold trust shares you own, which I personally think is a fair price for all the storage and security which is ultimately going to come with holding gold. Now, this fee does depend on which ETF you choose. Some ETFs will be a much higher fee. Now, these are small numbers, and although they might not seem like a lot now, but these fees will definitely add up, especially if you're owning it for a very long time. Now, my personal favorite, and the one I'm using right now, is the Ishares Gold ETF, which has the ticker symbol IOU. Now, there are a lot of risks to holding gold either way, whether it's the physical or via the trust. One of the risks to the ETF method is that you're relying on the trustee to look after all the gold that's actually there. One of the investment documents behind the Ishares Gold ETF actually states the value of shares will be adversely affected if gold owned by the trust is lost or damaged. They then go on to say that any losses because of various reasons don't put the trust liable. So if something happens to the gold they own, then the share price may drop significantly. However, personally, I think the likelihood of this occurring is relatively low because it has the BlackRock name behind it. I don't think BlackRock would risk something like that happening. So for me personally, I think it's a risk worth taking comparing it to the physical asset you're going to hold. It's going to be way more costly to hold it, and it's going to be way more of a hassle than just buying and selling the share. I currently hold around £750 worth of gold shares in my free trade account. So obviously holding gold either way could help diversify your portfolio against downturns with stocks. But you also could take advantage of the booming housing market by investing in REITs. So if you're interested in investing in property shares, then make sure you check out my video here where I discuss the top 4 UK REITs. Aside from that, guys, thank you so much for watching the video. Make sure you like and subscribe, and I'll see you next time.